don't believe it! The building is actually shaking! The cracks are widening by the second! Get back! It's starting to fall! In 1874, the City of London was the financial hub of the world. Here, thousands of clerks recorded every transaction by hand.
Watch the line. Almost done. Looks quite right.
Let's combine our resources.
That's a great idea. We will grow our wealth.
We must invest very wisely.
Diversification is the real key.
On June 1, 1874, a few old clerks met in a dusty London office. No press came, no one held a ceremony. They stamped some papers, they signed a final book, then they shut the doors. The business they ended had once been huge. It had an army twice as big as Britain's own. It ruled 1/5 of all people. It moved half the world's goods. On that day, it just stopped. The company was the East India Company. If you think today's big companies cannot fail, this story says something else. We live in a time of powerful companies. They shape what we see. They shape our roads and wires. They shape how we think. Every few months, someone says they are too big to break. But history has done this before. One company did not just rule a market, it became the market. It had its own army. It made its own money. It ruled millions. Then it died. Not just broken up, wiped out, gone. Why? The answer is greed. It loved easy money, and a hidden problem grew until it could not be fixed. To see how the biggest monopoly worked, go back to London in 1600. Queen Elizabeth I gave some merchants a deal. They got all English trade east of the Cape of Good Hope. They named themselves the Governor and Company of Merchants of London Trading into the East Indies. The plan was simple: pool money from investors, send ships for spices, bring back pepper, nutmeg, and silk. Share the gains, share the losses. This was a new way to run a business. It came with a big perk. No other ship could sail east without the company's okay. That's not just a lead. That's giving one player the whole game. At first, the company was just a trader with guards, but spice trading was rough. The Dutch and Portuguese fought hard. You needed more than ships. You needed forts. You needed guns. You needed your own soldiers. So the company changed. It became a military group that also sold cloth and tea. By the late 1600s, it built forts in Bombay, Madras, and Calcutta. It did not rent land, it took land. Then it did something else. It taxed the people on that land. Not trade, taxes. A business with shareholders in London now took money from Indian farmers. And the logic was simple. More land meant more taxes. More taxes meant higher stock prices. So the company took all it could. The company became a true ruler in 1757. That was the Battle of Plassey. Clive led the company's army. He faced the Nawab of Bengal. It was not a fair fight. Clive paid off the Nawab's allies. He won a fixed battle. He put a fake ruler in charge. Soon, the Mughal emperor gave the company the Diwani. That was the right to tax Bengal. Bengal was the richest part of India. Now, a stock company had a direct line to millions. Here's the ugly math. From 1765 to 1815, the company took about $1.2 billion in today's money from India. At the same time, it paid shareholders up to 50% each year. That was a huge payout, and people in Bengal were starving. That leads to a dark chapter. In 1770, Bengal had a famine. Crops failed. That happens. But the company made it worse. Its tax system was harsh. Farmers had to pay high taxes even when crops failed. Company agents kept grain. They sold it for profit. When the famine killed about 10 million people, the company's tax take barely dropped. The next year, it raised taxes more. This was not a market mistake. It was a profit machine running on human lives. Long before computers, the company found a way to print money. It didn't matter that the land was dying. The company's business set off a strange chain of events. The English loved tea. The company bought tea from China. It paid with silver, but silver was leaving Britain fast. So what did the company do? It grew opium in India. It smuggled that opium into China. Then it got the silver back. See the loop? The monopoly makes a problem. Then it uses its power to make an illegal fix. This led to the Opium Wars. Britain went to war with China to protect the company's drug trade. Think about that. A private company's needs dragged two empires into war, twice. The same company also dumped tea on the American colonies. That led to the Tea Act. That led to the Boston Tea Party. That led to the American Revolution. A tea monopoly lit the fuse for a new nation. By the 1800s, the company was a strange mix. Its trade was so huge that economists attacked it. They called it inefficient. Adam Smith wrote about it in Wealth of Nations. He said the monopoly hurt national wealth. The numbers backed him up. The company's costs were sky high. Corruption was everywhere. Every worker wanted to get rich. The only thing that kept it going was taxes from India. When a real audit came, the lie began to show. The British government was tired of bailouts. It started to cut the monopoly. In 1813, the company lost its trade rights with India. It kept tea and China trade. In 1833, it lost all trade rights. It became a government agent. The monopoly was not killed by a rival. It was slowly put down by its own government. The profits were private. The disasters were public. The end came with one big event. In 1857, Indian soldiers in the company's army rebelled. It shook British power. The causes were many: anger over land, bad treatment, hard times, and a rumor about rifle cartridges. They were greased with animal fat. That offended both Hindus and Muslims. But the real issue was deeper. Millions saw they lived under a company, not a government. It had no real right to rule, just an old paper from a dead queen. The revolt was crushed, but it scared London. The lesson was clear. You cannot give an empire to a stock company and expect loyalty. You only get a balance sheet. Within a year, Britain passed the Government of India Act 1858. It took all the company's land, armies, and power. It gave them to the crown. The company's board was gone. The company stayed on as a ghost. It wrapped up its last deals. Then, in 1874, it formally ended. What did it leave? A few desks, some paintings. Its furniture was sold off. The monopoly that once owned the future was now sold piece by piece. That's the strange truth of the biggest too-big-to-fail firm. It did not crash in one big event. It became useless. Then it was unplugged. Now step back, see the pattern. The East India Company shows that big monopolies don't fall to competition. They fall to the gap between private gain and public cost. The company became a risk to the state that made it. When it nearly lost India in 1857, it stopped being an asset. It became a burden. The state did not just regulate it took it over. It took the whole thing. Then it killed the brand. That's not antitrust. That's a political defense. Look at today. We have firms that control digital identity for billions, firms that build space gear, firms that own undersea cables, firms that shape talk with algorithms. We often say they are too big to fail, but the East India Company was bigger. For its time, it was a planet-sized firm with its own foreign policy, and it still failed. Not from lack of money. The system around it said the cost was too high. The government didn't break it up for competition. It killed it for stability. The hard question is this: are our modern giants near that line? We may not want to see it. Think about the parallels. A few platforms control information. That's like the company's grip on trade. They make money from attention. That looks like taxing peasants. They keep the profit machine running. When things go wrong, the costs hit everyone. The gains stay with the few. That same tension killed the East India Company. Its death took decades. It fought every change. It lobbied hard. It bought power. It said its fall would ruin the empire. Sound familiar? In the end, it was thrown away like old shares, not with a bang, with a stamp and a note in a book. The biggest monopoly died because the math no longer worked. It only worked for a small group of shareholders. Once the truth came out, once the rebellions and famines and wars showed the real cost, the state did something rare. It chose the long term over the easy fix.
So, the next time someone says a big company is too strong to fall, think of that dusty room in 1874. Think of the company with 260,000 soldiers. Think of the company that ruled 200 million people. Then it was gone. The real lesson is not that it fell. The lesson is that it took a revolt, many wars, and millions of deaths before anyone acted. What would it take now? And if we saw the hidden truth, would we turn away, or would we finally stamp the paper?